some point, the filter has to rely upon the trend and say, okay, we tried, it's a good trade now, let's go. And understanding that you really are not going to do better than that system. Random discretion may work out every now and then, but in the long run, it's not going to do as well as your systematic approach. But it's not saying that your exits are incredibly important. They seem more important because getting out of gold quicker or getting out of silver quicker may yield a much bigger return for this particular trade in this particular year. In the future, it could be the opposite.
Hey everyone, Ben Lichtenstein here. Before we get started, as always, a quick reminder, the following is intended for educational purposes only, informational purposes, and should not be considered trading or investment advice. I want to welcome Jerry Parker to the podcast, joining us to talk a little bit about trade entries and exits. Jerry, good to have you with us. Really appreciate you setting some time aside.
It's always a pleasure. Thanks for having me, Ben.
Absolutely. Absolutely. Jerry, really excited about today's topic because the timing just couldn't be better in terms of my process and some of the learning and some of the work we've been doing together. Again, as I mentioned, we're going to be talking about entries and exits today. And I want to kind of attack this conversation from an old versus new sort of discussion in terms of, bringing out some of the experiences that you've had over the last 40 years plus of trend following and trading under the structured kind of rules-based approach, talking about some of the evolution that you've seen or the process, how it's evolved for you, and also get into a little bit of why it's evolved. And again, I think that's key as far as some of the entries and exits and that discussion. But I wanted to start with one of your famous sayings, learn to love your trading system, because I feel like in some ways, before you can get into a trade, that's essential. It's important to have confidence in your trading system. But I feel like the learn to love it aspect sort of implies that you have to have been in a few trades and experienced it a little while to actually, to get to know it a little bit better. But talk to us just a little bit about learning to love your system and how that's kind of foundational before you even get started.
Whenever I have these sayings like that, I think they're really good at the time I say them. But then later, especially when you preface it like that, I was just wondering if I'm going to still like it. And I still like that idea. So yeah, you should definitely, I think one of the turtle questions was a trader should love their losses. Mm-hmm. And the answer, of course, is yes, because it's part of the system. So you should love everything about the system, the good and the bad, because the losses actually help, preserve capital and keep you in the game. So we should have confidence in our strategy, in the systems, the trend following systems, because we've done a good back test. And we really want to use that as the cornerstone and rely upon that back test and have confidence that, days and months, weeks and years may not turn out the way we want them to all the time, but we're looking at this from a long-term point of view, many, many years in the future. And we should have confidence that if we've done that good back test, and we should rely upon it and be confident to do all the trades at the back test that the system asks us to do, because we already have some evidence that at least it's kind of worked in the past. Things can change. We may need to evolve and change things in the future, especially the entries and exits. From my point of view, they have definitely changed since 1983. And gotten sort of longer term. Mm-hmm. And that's really one of the big lessons is today's trend following is looking at a look back of 9 to 12 months usually, and not a shorter term strategy that I learned in the 80s. Mm-hmm.
And in terms of how you got in the 80s and why you got out, we'll talk about that in a little bit. In terms of scaling and versus the single entry, single exit right now, approach is something I want to discuss as well. But just in sticking with this idea, again, learn to love your trading system a little bit. I hear what you're saying as far as losses, learn to love the losses. I remember when I interviewed you one time on the Schwab Network, I had talked to you about this learn to love your trading system idea, and you kind of equated it, or you presented it as sort of your trading a system is like a lot like your child. You love every aspect of your child, right? I mean, yes, there's some things that may need a little fine tuning, or there's certain things, certain qualities that you're that need a little work, but it's you don't pick and choose what you love about it. You love everything about it, and that's I like that approach. The other thing, that I'm kind of thinking about is, again, kind of breaking it down, sort of like the love your system, I feel like is sort of tied to the back test. Almost like a sports car, right? You love your sports car. It's in your garage, but your learn to love it really kind of comes from the experience and the time and the molding and the again, time and experience you have with it.
That's right, and you're going to learn over time that it does have its ups and downs, and the things you
Mhm.
don't like about it, the frequent losses, 60% losing trades, uh, profits turn into losses, big profits turn into small profits, infrequent outlier trades. But, you still overall, though, it is a winning strategy, and so that sort of has to be kind of the bottom line. Is this something that if they've, for a over the long term, is this something that's going to do really well for me? And that's what you have to sort of live through. A part of that is living through that and understanding that you really are not going to do better than that system. Random discretion may work out every now and then, but in the long run, it's not going to do as well as your systematic approach. Now, you can always desire and attempt to find a better parameters and a better approach and refine your systematic approach. But I think that's another thing is that you shouldn't expect to do better um, by not following the system. It's really the one thing you should always want to do is just follow that system and try to expect to get a similar return in the future of what you saw in the back test. It's never going to be quite as good, but that's the best we can try to achieve going forward.
Hmm. Consistency in terms of that approach, I'm picking up on is important, really important. Something that I feel like is equally as foundational as learn to love your trading system is, and you touched on it briefly, I think there for a minute, is the idea that every trade is created equal, right? So the system sort of provides you that opportunity to approach every single trade in the same way, which also kind of is conducive for that consistency as well.
That's right. That's what the computer did. It didn't pass on trades. It didn't have another opinion about the trade. Simply followed those rules. And that's the key for trend following, especially because you're inevitably going to miss a trade. It's going to go a long ways. Maybe you'll miss if you miss some trades and decide not to take them. Maybe they won't hurt you too bad. But eventually you'll get out. You won't do a trade that is going to be an outlier, and then that's really going to really harm your performance. It's a little humbling too because some of the trades we've seen recently, gold, silver, crude, crude oil.
Hmm.
There's no intellectual thing you can come up with that's better than those trades. There's not a parameter that keeps you out of a losing trade that is going to be worth it if it's going to miss any of those trades. So um, eventually, in a trend following strategy, you're going to sit back and realize, wow, I'm not really doing a lot here. It's these outliers that are taking me home and are making all this money. All I did was include it in my portfolio and take the buy signal when the system said to. So that's good and bad. It's a little humbling, but also it goes to show you that when you're losing money by following the strategy, you're really not doing anything wrong
Hmm.
as long as you're not over trading
Hmm.
and having a fatal drawdown. But it's really important to do those trades.
Yeah, I kind of stumbled across a podcast. I can't remember Top Traders Unplugged or something like that you had done, and you were kind of talking along the lines of missing that trade, but more you were talking about how the mistake is if you try and apply too many filters to try and minimize some of the losses or smooth out some of the returns. And you were talking about that if the filter creates a situation where you miss the trade, then everything's kind of out the window, basically.
That's right. Filters should have a kind of a bad name because it does imply missing a trade. I think a good filter would be something that, well, the breakout is a filter. The moving average crossover is a
Hmm.
filter. So if you have another type of a filter, that's good if it slows you down from getting into the trade. But at some point, you got to get in, um, and that's what a good filter will do. Maybe you'll combine it with a breakout or a moving average crossover to get confirmation, but it can't be something that keeps you out of a trade. I used to have a filter that kept me out of a trade if the volatility at the breakout at the entry was too high. Well, it could be too high for the rest of that trade.
Right, right.
What if the volatility was too high in that gold trade or that crude
Yeah,
oil trade? I
yeah,
would be out of it. So you
yeah.
don't want to have anything like that. At some point, the filter has to rely upon the trend and say, okay, we tried. It's a good trade now. Let's go. But just delayed the entry a little bit.
Yeah, it makes a lot of sense. Especially when you talk about it in terms of the gold trade. Yeah, if you had passed on it due to volatility, I mean, look what, and some of the other huge outliers, look what you would have missed. I'd imagine as it breaks out, you actually are seeing that increased volatility a fair amount of the time. Let's talk about, speaking of those breakouts or those moving average crossovers, those triggers. Seems like a lot of classic trend following systems, Jerry, use some sort of that breakout strategy, right, to enter markets. I'm kind of curious, do you think about it conceptually at all, like what a breakout means, or is it just simply a breakout?
I don't think it usually means very much. It's like I said, I think if you're lucky, you'll have 60%, only 60% losing trades or around in that area. So it's really not, it's just really a mechanism to help you be consistent and disciplined and do the same thing each time on every trade, long or short. It doesn't matter which market it is. So that's what that breakout is there for, just to enforce that consistency and discipline to handle each trade, each market the same way. And of course, could have multiple systems, different entries, shorter term system, a longer term system, and that sort of diversification is good.
Yeah, I want to talk a little bit about the diversification in a minute as well. We'll get to that in terms of different products, but also different systems, which is something that we've discussed a fair amount too. Sticking with this thought, though, for me, I always sort of looked at trend through the two phases of price development. I've talked about this with you a couple times, that sideways consolidation phase where the market's just kind of random and not really exhibiting a lot of conviction. And then you get that imbalance, which occurs, on some sort of a news related event or like, what's going on, for example, with crude right now. And you get that high conviction vertical phase where the market's seeking value. And then, it either finds it and starts to establish that sideways consolidation phase again, or it rejects that new upper level and kind of goes right back into that prior area of consolidation. And again, sometimes that's more easily identifiable than others, but when it really jumps out at you, it's like this staircase type pattern. You see again, just horizontal, vertical, horizontal, and it's kind of interesting to watch. But I also sometimes think that as I look at price through that lens, maybe I am kind of overanalyzing things or being a little overly analytical, because if you just look at it through the breakout lens or the crossover of a moving average or some other type of parameter, it kind of boils it down to a very basic or very simple focal point. And also that kind of feeds into one of the major premises, ideas, is that the whole idea that trend following is not about picking tops or bottoms, right? You're not being predictive here. You're just sort of, hey, it's a breakout. The system says to take the trade, so I'm going to take this trade.
That's right. And I don't think it's about pattern recognition and putting some
Okay.
sort of a prediction overlay of what the chart looks like. We got in, we have nothing to do until we get out. that chart could look a lot different. We could have two markets, we enter on the same day, we exit on the same day, but the charts themselves could look dramatically different. And there's nothing to be gained by in trying to interpret that. And what does this mean? It doesn't mean anything. You have an entry, you have an exit, and then you close your eyes in between. And there's no knowledge there to be gained. I think, there's no such thing in my mind as the trend is strengthening, you
Hmm.
know,
Hmm.
because right after
Or
the
weakening.
trend strengthens, it
Yeah.
crashes.
Yeah.
And then right after you have a couple of really bad days, the market goes back to new highs. So it's really not pattern recognition. We're not trying to, it's almost like we don't even want to say we're trend following. We did a back test. We have our parameters. The back test said the system is sufficient. It's going to work. It's going to make money and not have a fatal drawdown, hopefully, at least historically. And so we just, and so we can look at it and say, oh, yeah, I guess I am kind of following trends, but I'm a systematic trader first
Hmm.
and a
Hmm.
trend follower kind of second, or
Hmm.
just as a kind of a way to explain to everyone else, how does this strategy work? Um, Entry, exit, in between, close your eyes.
Yeah, I feel like saying you're a trend follower almost in some ways implies that you can predict or that you're trying to predict the direction in some ways versus just sort of like grabbing a hold, price is king sort of approach, you know?
Someone could challenge me and say, I see that you're still long this particular market. Do you still think it's in an uptrend? And I would say, oh,
Mhm,
yeah, it doesn't look very uptrend to me, but my system is still long.
mhm,
And this is a system that I back tested, and this is the best systems I could come up with. So, yeah, sometimes it's not going to always look like it's trending, but we're going to stay in it anyways. We have a stop loss, so we're not going to get out until the stop loss is hit. And so if you put a trade on immediately and it fails, hard to say that still the trend is still with you. It's just the computer says hang with it longer. And that's what I'm going to do. The computer is not wedded to trend following. It's wedded to these rules and these parameters. Um, so that's kind of how we have to approach it. There's less there than meets the eye.
mm,
Highlight that quote. There's less
mm,
there than meets the
mm,
eye.
mm. It
You
makes
see
me
more
think
than there really is, I guess.
it makes me think of another quote we used to say, to traders that have a tendency to overtrade and sort of overmanage stops and move them around and over twitch type trade, we'd say, don't just do something, stand there. Don't just do something stupid, stand there. Instead of
Yes,
don't just stand there, do something,
exactly.
because that's all they really are is just doing something. So, and I find it interesting, Jerry, when you talk about trend, it's so it means something different to so many different people. I mean, for some people it's just kind of drawing a line connecting a series of lows and calling it an uptrend until that line gets broken, or in a downtrend you're just connecting a series of highs on the way down and you're in a downtrend now until it gets broken or channel or whatever, or um but it also, the other thing it reminds me of is when you're doing that, again, I feel like you are being, if you're buying pullbacks at least and saying, hey, I'm going to buy a pullback in an uptrend, you're being very predictive, still saying that, hey, this pullback is a buying opportunity because it's going to reverse, basically, is what you're saying. And it's going to go back and make new highs. And it also makes me think of another saying that we used to have on the trading floor, which, boy, I hope this isn't too graphic, but we would say, you know what you get from picking bottoms,
Mhm. Funny.
stinky fingers.
Yes, funny.
So,
Yeah,
so
that's another a good rule, is to, never add to winners, never add to losers. Don't have the mentality that you wanna buy a pullback, buy the high. I have that trend following mentality every day, every minute of the day.
hmm, hmm, hmm,
Um, Because what's gonna happen if you have a system that buys pullbacks? You never get a pullback. That's just another bad
hmm,
filter that
hmm,
keeps you out of a big winning trade.
hmm.
Um,
Yeah, it
so I
seems
think
like
that
you
just
get
to
in
have
all the
that.
losers, but not all the winners.
Right, and just to have that mentality that I need a bargain, um, the whole point of this is that higher is better and higher is harder. So we wanna put ourselves in situations where we're doing things that are hard, do the hard thing, do the right thing. I think that mostly they're sort of the same thing. The hard thing is the right thing. And you hear a lot more people talking about buying pullbacks. It's a real um, trader personality flaw to desire such silliness. Be a grown up, and if you hear silly things like that, then try to avoid those things. Try to be in the minority and do things other people find hard to do. Today's high is what could be
The start of something big.
sort of something big.
Yeah.
I posted something on Twitter that I was just trying to make fun of, like in some of these um, energy stocks that have gone crazy
Mhm.
past week or so. I was like, were they cheap at the breakout?
Hmm.
Was it a value play at the
Yeah.
breakout? Was it overvalued? I mean, all of this is pretty silly stuff
Mhm.
when you're trying. People also want to mix in with their trend entries or their technical entries, fundamentals. Like I want the fundamentals and the technicals to agree.
Mhm.
I think
To
that's
match
another
up.
bad idea.
Yeah.
I want them to disagree. I
Yeah.
want everybody to disagree with me buying this breakout. That's the type of attitude you need to have.
Yeah, there's a couple things that makes me think of, like a lot of things in trading. My guess is I could ask you a question like, I'd imagine you sort of approach life in a very similar way, right? That sort of optimistic approach that Richard, taught you guys. Think like a kid, right? It can happen. That optimistic approach. Don't be skeptical, I think was the saying. I actually have it written down right here. Don't be skeptical. It can happen. Um, for traders, Jerry, I think the hard thing is buying that breakout, especially if they're not doing it in a structured, rules-based manner, in a consistent manner, because what's happening is they remember the trades that they bought the breakout and it pulled back and they were stubborn and they held it for too long and they took a real sting, a ding from that trade. They don't necessarily remember the trades that they may have had winners or small winners that the trade continued. So I feel like you sort of remember those bad trades or those unbridled trades, kind of where you just sort of let things run against you and you know that you shouldn't have. But when you have those structured rules based losses, it has a lot less of an emotional draw or impact on you.
I don't know. Maybe some people do get a little overwhelmed by losses, and I think it's the thought of the loss. I know for me, when I first started, it was thinking about that. I didn't want to take a loss. When I put the trade on, then I was okay. I was okay getting out of it, but sometimes I got a little frozen because I really didn't want to lose. But you really have the math backwards because the possibility on the upside can be sort of unlimited and really large, and then you're going to but on the losses, you're gonna keep them really small. So it's really, should be a no-brainer to, that the cost of putting the trade on that could really make your year, would be such a small percentage of your capital. So it's something that you just have to get used to doing. And some people need, failure and missing trades and, having that punishment of all I had to do was put the trade on, everyone else put it on, I was the only one. So that sort of, helps
Well,
you remember what you need to do.
talk to me a little bit about that, Jerry, because that was one of the questions I was going to ask you. As far as I remember, we've discussed this a couple times, and I've heard you tell this story a couple times. As far as, correct me if I'm wrong, but it was February heating oil in 1984, the one that got away, I guess you could say, quote unquote.
Right. It was the first big trade, and I think a lot of people missed that trade, Feb heating oil. How did we miss it? One of the big lessons we learned was don't miss trades. And so it's inevitable that if you start passing on trades for whatever reason, that one of them is going to be that outlier. That's the whole premise of trend following is that 5 or 10% of the trades are going to make all the money, pay for the losses, make the money. So you cannot miss those trades. There's no such thing as limiting the trades to what the computer would decide is the A plus trades. You have to take some C's and some B's as well. The setups may not always be perfect. Volatility may be higher than you want it to be. It could be a V top and a V bottom, no consolidation. That's not going to be probably as good, but your system needs to be flexible enough to, get in these trades that everybody knows was a big trend. It's not a question. Is this a big trend? No. If you have to ask, it probably wasn't. But the big ones, and we see them quite frequently. And the key is just to be in there and participate in them and have that exit be not too close to where you don't get out too quickly. These are all kind of subjective terms
Mhm.
that are, but we're going to base all of our entries and exits and stop losses and those parameters on the back test.
All right, let's talk a little bit about old versus new, because I remember in episode 1 and in episode 2 we touched on and discussed a little bit about how things have evolved and how nowadays your approach and the strategy that you are following is a one entry, one exit. But that wasn't always the case, Jerry, correct? I mean, as far as I remember and learned and kind of studied, the turtle strategy was more kind of tiered entry. So you would enter into a breakout trade, but if it continued in your favor, you would add. And I think there were 2 or 3 ads. Correct me if I'm wrong.
Yeah, I think that just has got misinterpreted over the years. So it's, for us, it was usually something like System 1 and System 2.
Mm.
Um, System 1 and System 2 had their entry and their exit parameters and a stop loss, pre-exit stop loss. And maybe one of the rules was space them out a little bit, if
Hmm.
because in a breakout, all the breakouts you trade could all actually happen on the same day at the same price. So as a kind of just a little tweak, spread it out a little bit. So there was no pyramiding, and there was no habitual adding, uh, you know, based upon increased prices. There was just System 1, System 2. System 1 was a little bit shorter term than System 2 on the entry and the exit. But if they happen to get hit on the same day, do one today, do one tomorrow, or space it out by an ATR or whatever. It was a trivial little tweak to each system. But you kind of know going in what your maximum position is going to be. System 1 has its position. System 2 will have its position. You know what the exit's going to be, the stop loss part of that exit. But as the market continued to go higher, you didn't continue adding and adding. That's just something I think that got misinterpreted.
Um, Again, the more we talk about it, the more sometimes I'm just sort of my mind's blown how much has changed in many ways, but also, Jerry, how much the kind of general or the original ideas and kind of themes or premise sort of remains the same. And I think that's a testament to the simplicity and the time tested aspect of this, and the self-sustaining or the ability to kind of continue along those lines. You talked a little bit about the um that it sounds to me like you're talking about kind of diversification in terms of entries. We've talked a little bit about diversification in terms of products, but I also remember you talking in the past about how it's important to kind of stagger your exits as well, right? If you have, for example, a trade like gold, um, you want to try and preserve some of those gains. And on a pullback, you want to get out if it's significant, but you don't want to get out too early. Obviously, you have to have, as you say, quote unquote, kind of loose pants in terms of where you place your stops. But that can also come from having a couple different strategies, right?
Right. So that's another thing that's just going to be a product of the back test. How long term do I want to be? There's a sweet spot in there. So System 1 is a little shorter term or materially shorter term than System 2, but they're both in that sweet spot.
Hmm.
They're going to make about the same amount of money over
Hmm.
time, over the entire back test. But for any one trade, one might do a lot better than the other, but it's just sort of a random situation. So that's, and the type of diversification we're getting here is not um, not a correlation issue. We're not getting much diversification as relates to the correlation because we want System 1 and System 2 to both be long gold.
Mhm.
So for a long period of time, if gold, as it's just as an example, gold keeps going up, it's 100% correlation. And we want that. We don't want system one to be short gold for some sort of bowing down to diversification and lack of correlation. The diversification we're getting is the final P&L in that trade. System one may make 50%, system two may make 100% or 25%. We don't know. Like I said, one of the great things about multiple systems from a trend following perspective is they will give you some diversification, but mostly on the profit, on the big trades that'll really make a difference because you really can't predict uh, when you should get in or when you should get out of these trades. It's just a numbers game and a probability game that'll play itself out over a long period of
Mhm.
time.
Mhm.
But yeah, that's that's kind of a frustrating part about trend is that you do get in a lot of these trades. They do have some big moves and they all kind of crash at the same time. But, like I said, the longer term system may have a drawdown, but the trade may go back to brand new highs. And that's what the back test will show. It's you can't predict the first big sell off. What's not always a good time to get out of the trade. Sometimes holding on to these trades longer works a lot better.
So possibly overkill on this last thought, sticking with the same topic. So if you want to, feel free just to say yes or no. But it makes me kind of think about, okay, so you've also said the back test would show that each one of these systems would perform basically about the same. So what you're doing right now is you're taking these systems, you're casting this wide net in terms of these diversification and in terms of the products that you're trading, but you're also kind of widening that net, I feel like, as far as the diversification in terms of adding some of these different parameters to these systems that will keep you in the trade a little bit longer than the other or such. But as you said, not necessarily short one system, long the other system. Um, so again, it just sort of, I feel like it just sort of adds to the diversification component of that element.
That's right. But you bring up a very good point. It is possible before a trend gets going to have a long and a short. System one could be long, system two could be short, or vice versa.
Mm.
As the market's in transition
Mhm.
and
Mhm.
you're getting out of the short, maybe system
Mhm.
one is going long,
Understood.
system two is staying short. That's perfectly fine.
Mhm.
Treating
But
these
not
two
something long in
systems
the
as
tooth.
Yeah, treating the two systems as independent. They don't know each other. They're not relying on each other. Um, that's important too. The signals are not coordinated. So you do the back test on system one, you do a back test on system two, um, then you add the results together to see how
Mhm.
they performed from a trade statistics point of view and from a equity curve point of view. So there'll be a limited um, value, but we should sit with the drawdowns. We should be bold with the profits, and all of these statements are true. But we're not going to choose not to have this type of diversification since there is no um, reason not to. The strategy is not weakened by having multiple systems, and you could have four or five, whatever. Split your capital up into different percentages based upon the number of systems and trade. It doesn't have to be just two, but two is way better than one. I would say.
I remember you kind of referencing the consequences, so to say, of not following your rules. Talked about the February heating oil in 1984 and lessons learned from that experience. But there's also this debate out there, I feel like, in terms of which is more important, an entry or an exit. Missing that entry, we've already established, is the biggest failure. So in some ways, not entering your trade, I mean, that would kind of say that entry is more important than the exit.
Well, the entry is definitely important, and I feel like that we're frequently making system improvements coming from the entries. um, so I do think that when you have a strategy that has 40% winning trades or thereabouts, um, and you're so 60% of the trades are losing trades, and you're taking these losses as a percentage of your capital. This is not something you kind of want to play around with. You kind of want to have optimal entries and do your best at um, being a good trend follower and making it hard to get into these trades, make the market show more trend. And so I think you can really pick up a few um, percentage points by really trying to do your best on the entries. The exits get a lot of attention, but I don't really understand why they should be classified as more important. They're just as important as anything else. You have plenty of time to to improve our entries and our exits. So let's just there's no reason to concentrate more time on the exits, especially when the fact of the matter is in a multiple trend following systems, the biggest pickup you're going to get from having multiple is diversifying each individual trade's profit and loss.
Hmm.
And these big trades, they dominate the performance, the gold, the silver, cocoa, um, short yen, crude oil. This is going to dominate the performance. So this is what it makes it look like that they're so much more important. But a good trend following exit, over time will make about the same amount of money as another good trend following exit. So it's really only like, how did I do in 2026? I'm glad I traded a shorter term and a longer term, because the longer terms didn't work out as well as the shorter terms. At least I have some shorter term exits. But then 2027, it may be the opposite, and it may come out to be a wash. And that's what I think you should expect. You're looking at the back tests, you're choosing these parameters, and over a 20 or 30 year period of the back test, all your systems make about the same amount of money. So where is this big pickup in concentrating on the exits? Well, in any individual year, system one and system two can look a lot different. Okay, I think that's worth doing. That's worth doing. It's not. There's no reason. There's no reason to not not desire that. But it's not saying that your exits are incredibly important. They seem more important because getting out of gold quicker or getting out of silver quicker may yield a much bigger return for this particular trade in this particular year. In the future, it could be the opposite. So that's why I think our brain is like, oh, this is really important. Let's make it less important and less all or nothing approach by trading multiple entries and multiple exits.
Yeah, kind of like treating every trade the same and not favoring one or the other. It sort of makes me feel like, I guess, the answer to that, well, to both questions, which is more important, a shorter or a longer time frame, your entry or your exit? I mean, it's not so much that it's not one or the other. They're just all important.
They're all important.
Yeah.
Yeah. Why
Equally
wouldn't we
important.
treat it that way? This
Yeah.
is a serious business. It's a serious game. Why not place a lot of emphasis and effort in all the entries and exits? Yeah. It's sectioning out some and trying to make a point that exits are more important. You got to have good exits, good entries.
So, Jerry, I wanted to here, hold on, I want to pull up the chart here so I can be sure I'm giving the right date. But basically, I wanted to get your thought on kind of and we've touched on this. I just wanted to sort of make sure that I was right in terms of what your thinking was on this. For somebody who's getting involved in trend following right now, and just kind of sticking with the gold example here, you've got whatever it is, an all-time high, roughly 5,600, we'll call it. And that was posted, when was that? That was the end of January, roughly, beginning of February. So you have these parameters where you'd say, okay, if you're trading a breakout strategy, in theory, you would, if gold were to make a new all-time high and trade above 5,600, if you had just started this, breakout strategy, then you would initiate along with that breakout. But you and I had talked about how, well, you got to kind of rewind the tape, because the real strategy or the actual breakout occurred back in what was it, January, February of 2023, right? As gold was breaking out through 1900, 2000.
That's right. So you have a little dilemma there. If you
Hmm.
want to start up trading, trend following today, what are you going to do about those trades that are long in the tooth?
Hmm.
So you have to make it's not an optimal situation. Maybe you want to do a little bit of gold with a stop loss at 5,600, the new high or whatever, uh, and sort of a hybrid approach, or maybe you want to not do it at all. Just wait for
Hmm.
new signals.
Hmm.
It's not a good choice. If you're a fund manager and you have new assets coming in
Hmm.
to an established fund and established gold position, you've got to take into consideration the new assets and put that position on
To
as if you
work,
put it
yeah.
on in 2023.
Okay.
But if you're trading your own account or trading for a client, a managed account for a client or your own account, it's a tough decision to make because gold could go to 10,000. It really is suboptimal not to put that on at the breakout. And that brings up another question. I've heard traders say, yeah, and I remember the first time I heard this statement and I didn't have a good comeback. It reminds me of reading some books, and I read these books, and I really got into them. And people would challenge me on about some of the issues of the day that I learned from these books that I read. And I knew the answer, but I knew that I should know the answer because I knew that my philosophy and the books that I had read were correct, and I just didn't know what that answer was. So um,
In
I remember
terms of
hearing
how to
for the
handle
first
this situation, you're saying, or?
Yeah, I remember someone said to me, "You should come in every day and look at the trade. If you wouldn't do the trade today, you should get out of it." And I said, "Man,
Mm.
that sounds right."
Hmm.
But like many things that sound right,
All
it
right.
can't be right.
Yeah.
Well, number one, Rich never told me to do that. So how could it be correct? But I think that the answer to that from a trend following point of view is um, the system is not telling me to be long today. It's telling me I should have been long at the breakout.
Mm.
But,
Well,
we
it's
do,
telling you should still be long today, but it's saying that you
yes.
should have gotten long at the break.
Exactly,
Right.
exactly. And
Right. Not
so
that you should be initiating longs today.
right, exactly. So that is the trend follower answer to that question. We don't look at it the same way,
Which,
but we live in a real world where we have to sort of massage these uh, philosophical things
mhm,
and these
mhm,
rules. So I'm
mhm,
not sure
to
how.
real world examples.
Yeah.
Yeah.
Yes.
Yeah, which makes me kind of think and sort of just puts me back in that same mindset last time we discussed this, which is sort of like you got to just be patient and wait for that next breakout. Unfortunately, I understand what you're saying in terms of allocating maybe a little bit or sort of tweaking the rule a little bit in this instance, but it's sort of like again, I just think of that original or that true breakout was, years ago. Um,
I think you could do both. One
okay.
thing that I would not rely upon would be the back test in this particular instance, because
Hmm.
if you try to do a back test, I don't think you would be able to come to a good conclusion.
Yeah, I'd
It would
imagine.
just be sort of a random question. And who knows? Like I said, you could do a back test and say, should I get into a trade that is a year old or 6 months
Hmm.
old?
Hmm.
And the computer may say no. And then on this particular situation, gold can go to 10,000. You're like, wow, why didn't I just do the trade and risk a
Yeah.
little bit from 5,600? It's a tough call.
Yeah, it is. It is. It's definitely something I thought I've struggled with quite a bit. Okay. So along those lines, um, that was kind of one of the things I wanted to talk about. I'd imagine in some ways, Jerry, I mean, you you had this crazy, experience in terms of the you know, um meeting Richard and being brought into that environment and the learning experience that involved. And we've talked about, how you were just in awe in terms of how smart these guys were and the fact that they were passing on this information to you. It I found myself kind of thinking about that in combination of where I am in terms of in my journey and my process as far as taking my trend following ideas and concepts from years ago and now sort of layering on this more rules-based structured approach to kind of take things to the next level. And it made me think about, like, in some ways how it must have been really cool for Richard and to kind of be watching you guys and watching that evolution process and just sort of like all the like energy that was going on, mental, intellectual, emotional, as far as the experience that you guys as traders were going through. And so get ready, because you'll probably be, have no idea or didn't anticipate, kind of watching that whole process with me. But I think that's going to be fun. And in some ways, um, um, it also made me think about another thing that you've told me about, Jerry, was how in the past, the idea was that some of the turtles had thought that maybe there was something that Richard wasn't telling them. And, or something that Richard hadn't told them in terms of the strategy, and maybe not so much like, I don't think it was you presented it in the idea that he was keeping a secret, but from my own personal experience, I know multiple times I keep thinking to myself, like, I have that same thought in terms of, is there something, Jerry's preached, and we talk about how the simplicity is key here, and that's one of the components. But there's also something in my mind that's like, is there something, not so much that Jerry's not telling me because he doesn't want to tell me, but more, is there something that I have forgotten to ask Jerry and he's forgetting to tell me? So I can kind of understand where that that turtle mentality came from. I sort of think, I always thought of it again along the lines of more like, it's the turtles thinking Richard doesn't want to tell him something, but maybe it was more the turtles thinking, hey, did Richard forget to tell us something? You know what I mean? Not so much that he was keeping information back, but was he forgetting to tell us that one specific bit of information that would be really important?
Well, that's interesting. I think that there were some goofballs there who who had that attitude, but the vast majority of the people understood, because they made a big deal about telling us how hard it was going to be, how difficult it is, and how
Hmm.
you have to choose to do hard. We're asking you to do things that are psychologically hard to do, and that's how you're going to separate yourself from others, by building rules that are hard to do. But if I say to you, like, Ben, it's really important to diversify, don't miss any trades, follow the rules, and don't get out too quickly. Then you come to me and you say, why did I lose so much money? I can't believe it. And you could say, well, I would say, well, you should have traded more markets. I told you diversification was important. Yeah, but I didn't realize it was that important. I was like, hey, look, when we're talking about trading, you better take it all in, and you better not discount anything, because it's like, okay, you've seen a movie where they say, okay, here's the code on how you disarm this bomb,
Hmm.
steps 1 through 10.
Hmm.
And then you blow up and you don't follow the steps. And your excuse is, well, I didn't realize number 7 was that important. What? It's on the list. It's
Yeah.
important. Trust me.
Yeah.
And diversify, take small losses. These things they're they're a way to succeed, and you can't skip any of them. Um, and just because we don't make a big deal about it. But then when you sit back and you're like, wow, uh, gold and silver and crude, this is the whole year. And you're like, yeah, that's the whole year. And if I would have missed one of those, what would have happened? Yeah, it would have been bad. And you should be very fearful, like, oh my gosh, I was told all of this, but now I've seen it in real life, how important these outliers are, and handling them appropriately. But what does that even mean? Following the system that's been back tested. See how it all comes together. So I downplay it using this subjective language of don't get out too quickly. What in the hell does that even mean? It means one thing. We did the back test, we have the rule, and we're going to follow the rule. And that's not getting out too quickly. Um, so all of this stuff is super important. And if you don't do it to a T, 100% of the time, not 99%, because missing a trade is kind of a subtle thing too, because you can miss 4 or 5 in a row and really save yourself some money. So it's a very, very dangerous attitude to have.
Yeah. they're all super important, and again, kind of just tying back to what we were talking about earlier, obviously equally important as well. Um, Last thought, Jerry, my dad always used to say, "Good things come to those who wait," and I sort of feel like this sort of feeds into that too. It's like kind of that strategy that you sort of sit back and you don't overcomplicate things. Um, it also kind of makes me think of what's the other saying? Take the goods, right? Don't overthink, what's being offered to you. Just take the good, and that seems like that's what this approach offers. Really is just the ability to kind of take a step back and distance yourself from that tick for tick, from the chaos of the randomness of price activity, and and again, and position yourself properly so that when the opportunity comes, the market, does the work for you, um, as a reward or benefit or what you get to reap for having done the work prior to.
I like that. Yes, let the market reward you. Don't get in the way of these markets. They will do all that you need them to do,
Mhm.
and don't get in the way and mess up and screw up these trends. That's just so important. And chaos, the news. Um, I think there was some sort of quote I'm trying to remember that Google had, like bringing order uh, to the world with the internet and search engines, and I think trend following brings order and a strategy to finance and investing. Um, and logically, I think it's no surprise that it's really hard to do. It's hard to believe in and to have that faith, and you have to almost relearn it or renew it very frequently, because long periods of time without big trends and profits can really weigh on everybody and anybody. But I think that's really the key. There have been periods where the trends were not, where the CTAs and trend following didn't do well. And pretty much all the studies just come out and say that we've analyzed it the last years, and what we're seeing is just not a lack of trend, just a lack of trends. So no fault. You didn't make a mistake. And there is no way to continue to prevent from getting whipsawed. You just have to trade smaller and diversify more. So if you've done all the trades the way you should have, give yourself an A+, and it's not based upon the money you made or didn't make.
Hey everyone, thanks for joining. Before we sign off, just a quick reminder, today's podcast was intended for educational purposes only and should not be considered investment advice.